What's your code red plan for when the market shifts from full steam ahead to full retreat mode? It'll happen for sure, and nobody knows when. Here are some important things to consider for when the market invariably shifts against you. I'm Bryan Ellis. This is episode 167.
You're listening to Self-Directed Investor Radio, America's only podcast exclusively for affluent, self-directed investors, where each day of the week you receive innovative investment strategy and deadly accurate market analysis that's untainted by Wall Street and unblemished by government propaganda, all in 7 minutes or less. Coming to you now from iTunes, Stitcher, and SDIRadio.com, here's your host, Bryan Ellis.
Hello, SDI Nation. Welcome to the podcast of record for savvy, self-directed investors like you. The last 15 years or so have really been a financial roller coaster, haven't they? Right now, it's easy for everyone to focus on the last 5 years, during which the stock market and the real estate market in America have both been screaming upwards, notwithstanding a bit of a slowdown in stocks this year. But that's not all there is to the story, is it? Let's look slightly more broadly, let's say 15 years. So since December of 2000 to right now, December 2015, what's really happened? I think you're going to be surprised. The S&P 500 has absolutely gone up. It sure has. By a whopping compounded annual growth rate of, drumroll please, 2.77%. Yep. And on a nationwide basis, real estate hasn't fared a whole lot better, increasing in the same period by a compounded annual growth rate of 3.2%. Now, to be clear, neither of those numbers factor in the effect of cash flow, dividends for stocks, or rents for real estate. Furthermore, it's not really accurate to compare the performance of all real estate to all stocks because 100% of the people buying stocks are doing so with the expectation of profit, whereas the commanding majority of people buying real estate do so to use it for living. So it would be far more accurate to compare all investment real estate to the stock market rather than all real estate, but hey, I give you the data we have. I suspect those aren't the numbers you expected to hear. After all, in the last 5 years, the S&P's annual number is closer to 11%, and the media is full of reports about the astounding real estate appreciation in places like Northern California, Denver, Dallas, Nashville, and even Detroit. The difference is, of course, that the last 5 years represents only the upcycle and not the rest of the story. What happens when the market shifts course? Maybe it'll be a deep plunge. Maybe it'll be a simple leveling off. Whatever the case. Do you have a plan? I was asked this question yesterday that really illustrates the point well. One of your fellow listeners named Ted reached out to me. Ted has a bankroll of about $1.1 million and is interested in buying some of the high-yielding turnkey rental properties we have available in Northern California. Ted's side of the conversation went something like this. Bryan, I get it that it's a great opportunity because I'm buying into a rapidly appreciating market and because my property will actually yield really attractive rents. And I get it because I'm paying a below retail price. All of that makes sense, and I'm ready to sign on the dotted line. But what happens if the economy in Northern California dries up? What then? Well, that's a fair question. It's absolutely possible the economy could fall off, or there could be a terrorist attack, or anything else. I don't have a crystal ball. Ted doesn't either. You don't either. But what Ted does have, and what you have, is very powerful. It's the power of intention. Here's what I mean. If Ted is clear about his intention for the investment, then that intention will guide him through any changing market situations. In Ted's case, he told me he really likes cash flow and tax benefits that he gets from rental property. And that's why he's bought a lot of other rental property all over the country, mostly in lower priced regions where his cash flow from rents is really strong. He also really likes that he'll be able to pass his rental property on to his heirs when that time comes. But what attracts Ted to this specific opportunity in Northern California versus buying more houses in other markets like Ohio or Indiana is the potential for real, near, and long-term price appreciation. You see, in most markets, it's not possible to get high ROIs from rent and strong property appreciation. It's just the fundamental nature of real estate markets. It's nearly always an either-or situation. But in this case, Ted, and possibly you as well, can get very attractive cap rates of 6 to 10% and do so in a market that Zillow predicts will appreciate by 19% in the next 12 months. So to Ted, that appreciation is the attraction factor, but it doesn't change his core objective to generate strong cash flows and tax benefits. Now, will those things be affected if the economy in Northern California cools? No, not really. I mean, rents won't likely drop much, if at all, because there's a severe housing shortage in the area with basically no new construction happening to alleviate that issue. So even if Ted And Zillow and most experts are totally wrong. And the tech and financial sectors that drive Silicon Valley really cool down economically, Ted will still be getting what he wants, which are strong rents, great tax advantages, and a property he can pass on to his heirs. And he'll still be in a market that has huge, huge upside potential. So what about you? Do you have real clarity as to what you're really trying to accomplish with your investments? As an affluent investor, you've likely got your basic cash needs covered already. You've also likely got a collection of investments performing at various levels, and you probably have a bankroll of cash that you're considering deploying, or maybe you're thinking of cashing in some stocks or annuities to be more liquid for the right kinds of opportunities. So if your focus is cash flow, then day-to-day or even year-to-year price fluctuations really shouldn't occupy your focus that much. Similarly, rental income potential isn't really relevant to short-term flippers, but market fluctuations can be really important. And one of those isn't really necessarily better than the other. It's all about your specific objectives. So what really matters to you, my friends? This issue of priorities, more specifically, clarity of priorities, is just huge. It's core. It's fundamental. By making the decisions right now about what things really matter to you, you'll be able to make good decisions, wise decisions, decisions that respect your capital later on if and when a market changes or some fundamental shift happens, and you're forced to make a should I stay or should I go type of decision. Well, what did Ted decide? He's going to diversify geographically and buy a few rental properties from us in Northern California. He'll get the cash flow he needs, the tax benefits he needs, and he'll also get something he's not getting from any other market where he owns rentals, an extremely high probability that the properties he buys from us will experience substantial price appreciation over the long term. After all, look at San Francisco, the centerpiece of Northern California. There's absolutely been price volatility over the years, but the long-term trend is absolutely, positively, without a doubt, overwhelmingly positive. So here's your homework for today, my friends. Assignment number 1, clarify your own priorities. Decide what really matters to you. What are the make or break requirements for your investments? Is it rental income, price appreciation, tax benefits, etc.? Decide what matters to you right now as a basis for making your own wise investment decisions. And assignment number 2 is this. If you'd like to own rental property at very affordable prices that are both high yielding in cash flow and located in the blazing hot markets of Northern California, then you've got to reach out to us right now at sdiradio.com/nccashflow. That's sdiradio.com/nccashflow, as in Northern California cash flow. You're going to love what you find there, just like Ted did. My friends, invest wisely today and live well forever.
Thank you for listening to Self-Directed Investor Radio with Bryan Ellis. Don't miss a single episode. Be sure to subscribe to Self-Directed Investor Radio right now on iTunes, on Stitcher, and at SDIRadio.com. Your feedback is always welcomed via email at feedback@SDIRadio.com. This show is for entertainment purposes only and is not intended as legal or professional advice for your situation. Content is the property of the Self-Directed Investor Society.